IDR Profile 2, otherwise known as the Pickle, right, includes pay-as-you-earn eligibility, right? And the only people that can be eligible for pay-as-you-earn is somebody who graduated from vet school in 2012 or later, right, based on when pay-as-you-earn started and the rules that require you to be a new borrower to meet the pay-as-you-earn eligibility requirements, right? So let's look at IDR Profile 2, right? So I'm going to open a new My Student Loans tab. I'm going to upload a student aid data file that has that IDR Profile 2. This one. All right, again, so we didn't see that FEL alert indicating that you had some active FEL balance that could benefit from consolidation, but we are seeing a anniversary date, right, which tells me that this person's using an income-driven repayment plan. That anniversary date is December 15th of this year, right? So not as far off in the future as the last one, but still pretty good. So this person also has some health profession student loans, right? Now that's something that you won't see in your student aid data file, right? This is one of those things where somebody tells us, well, I've actually got $200,000 of student loans, but your file only shows 170 because the remaining 30 is a loan type, a federal student loan type that doesn't exist in the student aid data file, right? So if I know that, then I'm going to add those loans to this, right? In this case, this person actually has $20,000 of health profession student loans, right? So I'm going to add those loans there. The servicer, I'm not, it could be Heartland or ECSI, depending on who has that. Let's just give them a school, right? The health profession student loans are always at 5%, right? They can be included in a consolidation. This is a great time to do that because if you consolidate those health profession student loans with your existing loans, even though you graduated, in this case, 10 years ago, that balance that you add to the consolidation loan will receive the 10 years of repayment time you've already logged, right? So you're not going to reset your repayment time. You'll actually add additional balance to it that absorbs that existing repayment time that you currently have, right? So this person, especially if you've got, $20,000 of health profession student loans remaining, this would be a great time to consolidate all of those loans, right? So you can add that additional balance because by itself, this is not eligible for an income-driven repayment plan. It's on a separate standard 10-year plan. So you're making two separate payments, one to your direct loans, another one to your health profession student loans. And if you're likely to hit forgiveness, you want to get as much of your balance as possible into that consolidation loan, and you're not going to reset that forgiveness time. So that balance will now be included in your income-driven plan payment and take on that existing repayment time that you've already earned, right? So this is a good one where somebody could benefit from consolidating, even though most of their loans are all direct loans. So if I come over to the income-driven repayment eligibility tab, after I've added in that health profession student loan, I can see I've got various numbers in the different available income-driven repayment options, right? Pay as you earn, but not the new version of IBR. This puts me in IDR Profile 2. Right now, pay as you earn is also one of the options that's going to be phased out on July 1st, right? And this person's using revised pay as you earn, otherwise known as SAVE, right? If this person wants to use pay as you earn for their new consolidation balance, then they're going to have to apply for that during their consolidation loan and submit that before the deadline to have a chance at using pay as you earn before it's phased out. And this balance is kind of in that range where we see pay as you earn is probably going to be more beneficial than SAVE, particularly if you've already got 10 years of time logged in repayment, right? So you're going to be closer to forgiveness. So let me back up a second. So pay as you earn, the difference between pay as you earn and save. Pay as you earn has a shorter time to forgiveness for people with graduate school loans, i.e. anybody who went to veterinary school, right? Veterinary school is considered graduate school. Graduate school loans have some different rules in repayment when it comes to forgiveness than having all undergraduate loans. So pay as you earn allows you to reach forgiveness at 20 years. Save requires you to be in repayment for 25 years. Now, Save has some benefits to it that are a little bit better than pay as you earn, but for some people and for some outcomes, pay as you earn is a better choice over Save. You reach forgiveness sooner, you may pay less in total, right? And for some people, they want to be done with their student loans before, in a shorter time frame than Save provides, right? If that's the case for you, you want to select pay as you earn before the end of this month, because then it's going to be phased out, right? And once it's phased out, if you're not in it, which this person's not, they're not going to be able to select it, even though they're technically eligible for it, right? And that's what makes this IDR profile 2 the pickle, right? It's a tough call. And especially with only a couple of weeks left, you have to make that decision. Do I forego pay as you earn? Or do I choose it before the phase out date? Right. But better to have that decision and do some analysis and make it kind of an active decision on your part, as opposed to just kind of losing access to it. Right. I mean, if this person doesn't know anything about this and they just continue on and revise pay as you earn on July 1st, revise pay as you earn it is, right? You're not going to have access to pay as you earn any longer. Right. So run those numbers, and that's where we use the loan repayment simulator, right? So how do I compare whether or not Save or Pay is better for me, right? So that's where I'm going to send this information over to the simulator, right? And because we're going to encourage this person to consolidate their loans, we're going to choose the consolidation option. One of the side effects of consolidating is it will take your unpaid interest and add it to your principal, right? But that if you're going to add balance to it, or you're going to add forgiveness time to your loans, or you're going to convert FELS into a direct consolidation loan that's eligible for the forgiveness count adjustment, don't worry about the unpaid interest capitalization, right? It's just part of the process, and it's going to be more helpful to do all of those other things than to not consolidate just to avoid the unpaid interest capitalization. Years of repayment, this person has at least 10 years in repayment, right? So we're going to make sure that we add that years in repayment to our best guess of what we're going to receive in forgiveness time, right? This is a really common mistake that people that share simulation links on the message boards, where they're analyzing the repayment options, they're like, I'm not really sure which repayment plan to choose. First step is to make sure that you account for the amount of time that you've already logged, right? Because that will have a significant impact on your simulation, right? So we want to make sure that we count those years in repayment. On our consolidation loans, if we're using the auto pay feature, we can also subtract off 0.25% from our interest rate for a discount. So 6.3 here in this example. Now here, we have to guesstimate our what our payments are going to be, right? So that's based off your income, right? Taxable income is the best input to put in here. So pull up your most recently filed tax return, look for the adjusted gross income item on there. As long as that number is less than or equal to your current income, put that income in here, right? So let's just put something in there, right? Depending on how you're paid will determine largely how you assume your income is going to grow over time, but you're going to know that best just based on your income history. If you're married, you'll add that information in here. Yes, no, not yet. If it's imminent, you can put the date you're going to be married. If you have dependents or you have children that will be born in the next 12 months, you can add them as family members for student loan repayment purposes. That's all accounted for in the income-driven repayment calculations. If you're planning for forgiveness, right, we want to assume some kind of tax rate on that forgiveness. And if you have an active fund that you're building to pay that potential tax, then you want to indicate what type of return you're earning on your forgiveness savings fund, right? And if you have some dedicated amount already allocated for that, enter it in there, and we'll factor that in as well. You run the simulation here, right? In this case, this person is currently using save, would reach forgiveness in 15 years from now. But if they switch to pay when they consolidate, they'd hit forgiveness at 10 years. Right? This is pretty compelling evidence that pay as you earn is maybe a better option, right? Without going into a lot of really ugly details, this remaining balance amount considered against their income, right? So their debt to income ratio suggests that pay as you earn will generate a more favorable outcome than save. Right? The higher your debt to income ratio gets, the more it favors save. Right? In this case, I mean, there's a sizable difference, $50,000 difference in the projected total cost, provided our income assumptions are reasonable. Right? So I'm probably going to steer this person into pay as you earn. Right? And but the side effect of reaching forgiveness sooner is the tax is probably going to be a little bit higher, and you're going to have to come up with that money sooner rather than later, right? So your forgiveness planning fund is a little bit more burdensome than if you stuck with a plan like Save that gives you an extra 5 years to plan for it, right? So this is, again, why we call it the pickle. The pickle is really, it's tough. It's tough to actually come up with a definitive answer in terms of what should you use, right? So when we start with the numbers, how does this look, right? Is this scary to think about this tax and this amount to dedicate towards a fund that you'll use to potentially pay this tax later on down the road? If not, then go for it, right? If it does, then there's nothing wrong with sticking with Save. Just know that you're going to lose access to pay as you earn when you're in this particular profile, IDR profile 2, aka the pickle. And this is how you run that simulation to tell. But again, and the reason why I don't spend a lot of time talking about non-income driven repayment options, because look at how much more beneficial this is compared to just trying to pay the balance to zero quickly, right? It's not even close, right? So the income driven plans, particularly when you have a robust amount of forgiveness time credited to you, are extremely beneficial, right? And a lot of people have a lot of really robust forgiveness time coming to them because of the forgiveness count adjustment and how they're counting all of that past repayment time, right? So, it's really imperative that you take a close look at your student loans, know which income-driven repayment profile you're in, right? And run some simulations to see what that outcome is likely to be, counting for the number of years you're likely to receive in forgiveness.